to continue safeguarding the peg between the Namibia dollar and the South African rand, while supporting the domestic economy, the MPC unanimously decided to keep the repo rate unchanged at 6.75%. This policy stance was informed after a thorough review of current and projected domestic, regional, and global economic developments. Let us consider domestic economic developments that inform this decision. The domestic economy maintained positive momentum during the first 6 months of 2025. Domestic inflation has remained subdued since the previous MPC meeting, while growth and private sector credit extension improved further. The merchandise trade deficit has continued to narrow, while the stock of international reserves has remained sufficient to maintain the currency peg and meet the country's international financial obligations. Domestic economic activity expanded during the first half of 2025, albeit at a slower pace compared to the corresponding period in 2024. The expansion primarily reflected improved economic activity in the mining, tourism, wholesale and retail trade, transport and communication sectors, as well as the crop farming and electricity subsectors. Meanwhile, activity in the diamond mining subsector remained weak. Looking ahead, real gross domestic product growth is projected at 3.5% for 2025 and 3.9% for 2026, relative to 3.7% in 2024. This forecast represents downward revisions of 0.3 percentage point for 2025 and 0.1 percentage point for 2026 compared to the April 2025 forecast. The revision to the 2025 growth is largely ascribed to a contraction in primary industries, particularly the livestock subsector, on account of restocking activity. Risks to the domestic outlook remain tilted to the downside, primarily reflecting the impact of global trade policy shifts, depressed international diamond prices, and geopolitical tensions. Domestically, water supply interruptions, especially in coastal towns, could likely weigh on growth prospects. Annual inflation eased to 3.6% on average during the first 7 months of 2025, relative to 4.8% during the same period in 2024. The deceleration is primarily attributed to lower inflation in the categories of housing and alcoholic beverages, augmented by the deflation in the transport category. Since the last MPC meeting, however, inflation stood at 3.5% in July 2025, unchanged compared to the May 2025 print, although it ticked higher to 3.7% in June. For 2025 and 2026, inflation is forecast to average 3.8% and 4.2% respectively. This forecast is 0.1 percentage point below previous projections for both 25 and 26, reflecting lower crude oil price assumption. The annual growth in private sector credit extension shows positive signs of recovery, rising to 5.7% in June 2025 compared to 4.5% in April 2025. The signs of recovery are also confirmed by the private sector credit extension growth, which rose to 4.6% on average during the first half of 2025 from 2% during the same period in 2024. This recovery was primarily due to the higher uptake of credit by businesses, especially in the categories other loans, advances, and overdraft, as well as installment sale and leasing credit. Turning to the external sector, Namibia's merchandise trade deficit has narrowed by 28.2% to 12.8 billion Namibian dollars during the first 6 months of 2025, compared to the same period in 2024. The narrower trade deficit was due to a substantial rise in export earnings, predominantly from uranium and gold, compared to the moderate increase in import payments. The stock of international reserves remains adequate, rising to 58.1 billion Namibian dollars at the end of July 2025 from 57.4 billion Namibian dollars at the end of May 2025, aided by SACU receipts. This level of foreign reserves translates to an estimated import cover of 3.8 months, which is considered adequate to sustain the currency peg between the Namibia dollar and the South African rand and meet the country's international financial obligations. Let's consider developments globally. The global economy continues to exhibit resilience, with the medium-term outlook revised upward. Since the previous MPC meeting, global inflation has generally remained contained. Key global stock markets gained, while bond markets varied. Monetary policy stances eased across several of the monitored central banks. Global growth has been treading water since the previous MPC meeting, according to the available second quarter GDP data. Year-on-year growth was unchanged in the US, while it slowed in the Euro area and China. Looking ahead, the International Monetary Fund, in its July 2025 World Economic Outlook update, has projected growth at 3% for 2025 and 3.1% for 2026, compared to 3.3% in 2024. This is a lesser deterioration in growth compared to the previous World Economic Outlook forecast that was released in April 2025. Developments in key commodity prices were mixed since the last MPC meeting. The price of gold fluctuated somewhat, but has softened below the level observed at the previous MPC meeting. Crude oil prices declined since the last MPC meeting, consistent with the increase in oil production, thereby assisting in the containment of inflationary pressures. Turning to base metals, zinc futures prices continue to rise, largely supported by a decline in global inventory levels. Copper prices rallied in late July 2025, but then declined notably following the United States exemption of new tariffs on refined copper. Despite falling from the June 2025 highs, uranium spot prices have remained firm, aided by underlying demand for carbon-neutral baseload electricity supply. Diamond prices remain subdued, mainly due to a weaker global demand and partly due to competition from lab-grown diamonds. Key global markets generally gained since the last MPC meeting, fluctuating higher despite the imposition of new tariffs by the United States. Bond yields have shown divergent patterns across the monitored economies, with yields on balance edging higher in Germany, Japan, and China, but receding somewhat in the United States and falling notably in South Africa as policy actions and pronouncements by the central bank resulted in lower inflation expectations. Inflation in key economies has adjusted upwards since the June 2025 MPC meeting. Among the monitored advanced economies, inflation rose in the United States, the United Kingdom, and the Euro area, but eased in Japan. Additionally, inflation edged higher in most of the key emerging markets and developing economies, except in China, where consumer prices stabilize. Looking ahead, the IMF expects global inflation to recede from 5.7% in 2024 to 4.2% in 2025 and 3.6% in 2026, broadly unchanged relative to the April 2025 World Economic Outlook. With regards to policy rates, most of the monitored central banks held rates steady since the June 2025 MPC meeting. In the key advanced economies, the policy rates of the US Federal Reserve, the European Central Bank, and the Bank of Japan remain unchanged, while the Bank of England reduced its policy rate. Meanwhile, trends in policy rates in the monitored emerging markets and developing economies varied, with the central banks of China and India holding rates steady, while those of South Africa and Russia reduced rates. Conversely, the Bank of Brazil further tightened its policy rate. Against this background, the monetary policy unanimously decided to maintain the repo rate unchanged at 6.75%. Commercial banks are accordingly expected to keep their prime lending rates at 10.5%. This policy stance will continue to safeguard the one-to-one link between the Namibia dollar and the South African rand while supporting domestic economic activity. In accordance with the guidance note issued by the Bank of Namibia in June, commercial banks are expected to reduce their prime lending rates by 12.5 basis points to 10.375% by the end of September 2025. The normalization in the prime repo spread that is in the pipeline is expected to provide support for domestic economic activity and credit growth going forward. Maintaining the repo rate unchanged while the anchor country's repo rate was reduced in July was the further step towards narrowing the interest rate differential between Namibia and South Africa. The MPC is pleased to know that while the gap has been closing, the repo rate in Namibia would remain 25 basis points lower than in the anchor country, which is good for supporting the domestic growth, without jeopardizing the stability of capital flows that has been observed to date. The MPC further acknowledged the South African Reserve Bank's recent announcement of a reduction in its preferred inflation rate of 3% from 4.5%. The committee welcomes and recognizes the positive policy development associated with this stance to promote price stability and strengthen monetary policy transmission.